Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 and today is DR Horton, ticker DHI. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, this company has a market cap of $24 billion, enterprise value of $29 billion. So we can see that they have about $4 to $5 billion in net debt leverage on this business. They operate in the household durables industry. They are a home building company based in, it looks like, almost all parts of the United States. It says 31 states, 98 markets under the brands DR Horton, America's Builder, Express Homes, Emerald Homes, Freedom Homes. Company constructs and sells single-family detached homes, townhomes, duplexes, triplexes. Also provides mortgage financing services, title insurance policies, etc. They develop, construct, own, lease, and sell their properties, and it serves primarily home buyers. So, interesting business there. This is basically a home builder, pretty generically, and they are operating all across the United States. So that gives us our framework. Now, return on invested capital is important. It tells you a lot about the business quality. It also can tell you a lot about some of the unit economics and how they operate in different cycles. And what you can see here is that they have 3 losses in the last 20 years, 2007, 2008, in 2009. 2008 was particularly bad in terms of home losses. That makes sense in the context of being a home builder, because the 2007 to 2009 financial crisis primarily impacted housing, home loans, etc. And so when you think about all the losses here, that makes sense. They did lose a lot of money in 2008, 31% of the return on invested capital, 6 and 9% in 2007, 2009, respectively. Now, generally, I like to see 19 years of profitability. That basically means only 1 loss in the last 20 years, but they have 3 losses, and they are concentrated in a deep way in the 2007 recession. What this chart's basically telling us is that this company is cyclical. Now, it's not huge cyclicals, but it's like huge short cycles, but it is long cycles. You can see growing and improving returns on invested capital right before the cycle peak in 2005, and we're seeing similar growing returns on invested capital up until the current peak at 22% in 2021. So this makes me concerned that maybe you're at a nearby top, and so that you might see another downturn cycle in the near future that could impact these return on invested capital numbers. This is supported by the fact that the PE ratio here is 4.5. When you look at these key statistics, this is actually quite low. If these numbers hold true, if you feel good about all these numbers, then this company is really cheap. Anytime you can get a company for 4 or 5 PE, it is a cheap idea, especially when it's growing at these rates. I mean, look, 22% revenue CAGR, 16% asset growth, 58% free cash flow, 47% EPS. These 2 numbers alone are outstanding. 20% plus revenue growth is outstanding. And to get all of that at a PE of 4, if this PE of 4 is sustainable, if those earnings are sustainable, this is not only a great deal, it's an amazing deal. This is the type of like once in a lifetime deal that you could get. However, the market is telling us that they don't think these earnings are sustainable. The market is telling us that they expect some sort of housing downturn in the near future. And so that's what you need to be aware of with these numbers. Otherwise, this is the setup for what exactly I'd like to see. If I could only see the last 10 years, or if I can only see basically back to 2013, I'd say, hey, look at this amazing company. You start out at $6 billion in revenue. You end at $27 billion in revenue. You've basically 4 to 5x your revenue in a decade. You've gone from $1.33 per share to $11 per share. You've almost 10x your earnings in a decade. Let's call it 9x. So 4 to 5x your revenue, 9x your earnings per share. That is amazing compounding. If you could just keep going that forward, you'd be set up for a very strong business. The problem is you can't do that going forward. You'd have to go from $27 billion in revenue to $100 billion in revenue. That's a huge jump. And so to expect another 9x would take you to $100 earnings per share. That just doesn't seem sustainable. So it's something to be aware of, that you shouldn't expect a repeat of this growth rate. And you should also be aware that it probably looked similar in 2005 as it does today, except we now have this past history. So without that past history, I'd probably be a lot more excited. So I am a little hesitant because you are hitting the metrics that I like to see. 15% return on equity, over 10% return on invested capital, pretty good double-digit revenue growth, earnings growing faster than revenue, cheap valuation. Like I said, all these things combined to look really, really good. But we have this financial crisis in the rear view. You need to remember that. You need to take that into account. And for me, this alone would probably discourage me from investing because I don't like businesses that can lose that much money in a downturn. But if you're enjoying this video, hit that like button. Don't forget to subscribe. And if you ring that bell, you'll get notified as I upload new videos each and every week. I'm uploading 3 videos a week, Monday, Wednesday, and Friday, each time covering a new stock, going over their investment prospects. And I have a whole backlog of over 120 S&P 500 companies. And a link to that playlist is going to be at the end of this video. So stay tuned for that. Now, on the income statement, you can see that the gross profit margins are staying pretty steady here, just as this is continuing to grow up. Your gross profit's gone up a significant amount, but basically 8 to 9x over the last decade. I mean, you can see trailing 12 month at $10 billion. So they're growing really, really rapidly. Very good gross profit growth. The net income growth is up 5x in a decade. Very, very good. You can see that the EPS is slightly lagging the net income, going from $3 EPS, $15 or $2.77 to 15 because of the fact that they're diluting you. So your diluted shares have gone up from 318 to 361. So they've been diluting across the decade, and you can see that impact there, about a 15% dilution rate. That's what's allowing them to grow so fast. If you think about this, their returns on capital don't support a growth rate this high. You can't grow your revenue and EPS faster than your returns on capital unless you're leveraging up the business more, either through dilution or additional debt. And that's what we're going to see here. They are diluting you, and I believe they're also going to have additional debt here. So you can see they've grown their debt $1.7 billion to $5.4 billion. So they have been increasing their debt. They basically tripled it over the course of the decade. Now, that is slower than their growth in earnings. So, okay, that's actually not terrible. But you have increased your inventory a lot. Your inventory is up 5x, $3.4 billion to $16.4 billion. So this is the big driver of your assets. You're not really based on net PP&E. It's really all in inventory. If I had to guess, that's land. Now, those numbers are workable because you have a very strong asset base supporting the market cap, $24 billion market cap, and yet on a balance sheet, $16 billion in inventory. If that $16 billion is land, that's pretty good. Assuming you're paying reasonable prices, then you're in a good situation there. So nothing wrong here. I mean, your market cap basically matches your assets. If you were able to ignore your liabilities, then that would be helpful, but you can't. But something to be aware of, it looks like it's really well managed. Let's look at our cash flow numbers. You can see the working capital is quite high. I think this is the investment in inventory. Stock-based compensation exists here. I don't really know why you need stock-based compensation on a home builder. Why they're having to dilute you like that, other than the fact that they don't want to pay their people in cash because that would limit their growth, and so it allows them to grow faster. That makes sense there. Another thing you see is you have these negative cash flow from operations. So despite having positive net income here, they're having some negative cash flow from operations. The other thing that's really important with these changes in working capital is you can see massively lower cash from operations than the net income. This is a key driver here. So look at this. We have this $500 million cash flow from operations against $4 billion in net income. So if we just go for what are we trading at on our cash flow from operations multiple basis, now it's a big problem because now you're at a 48 times multiple compared to your cash flow from operations. Your cash flow is being dumped into this inventory growth. And so a lot of it needs to know, is this truly growth that's going to sustain? Are these investments being useful? If it is, it can pay off. But all this net income is not really free cash flow. You're needing to recycle that back into the business to stay afloat, to grow like this. And so if they continue to get good returns, it's going to be okay. But you really need to understand these numbers and how they compare to the net income before you can get a good grasp on the business. So there's a big concern there that all the numbers they're reporting to you are overstating the profitability of the business. It's hard to do that analysis based upon this data here, but it's something you would need to be aware of before investing. So I think DR Horton has a lot of makings of a very strong compounder for some period of time. The question is you really need to time it well. If you think about buying this business in 2013, you would have done extremely well over the last 9 years. But the same was probably true buying it 9 years before 2005. And so what you want to be able to do is you'd have to be able to predict getting out before the housing recession. We could be going into one now. Mortgage rates have gone up from in the 2% range to over 6%. I believe it's going to slow down the housing market. You could have a slowdown in home building, and so that could be a big headwind for a company like this. But if you think you can accurately predict cycles, then something like this, where you have massively accelerating return on invested capital over the course of a long bull cycle, could cause you to make money if you can time it well, but it's less appealing as a long-term hold. So for me, I'm going to avoid DR Horton. It's not going to go on my watch list, but I think there's a lot of really interesting aspects here for those that have this type of business in their wheelhouse. So thank you for listening, and until next time, stop paying fees, start building wealth. Don't forget to like this video, hit that subscribe button, and if you like this style of content, if you want to be able to do your own analysis using this software, it is quickfs.net. There is an affiliate link in the description below. The first link in the description will take you to quickfs.net, where you can sign up for a free or paid account there. And if you use my link, I would get a commission when you sign up. So I really appreciate using my link. This is the software I use for my own analysis. This is how I do my analysis. So I hope you have gained value from it as well. Until next time, bye.